The S&P 500 finished the week on a high note, but not all the indexes did. So we take a look. Is this the resistance finally that the market's going to hit its head up against? If so, where may it fall down to and how long may that take? So we take a look at that from a technical outlook, what may drive that, and what could drive us to continue to move higher up towards 2,800 and potentially beyond. So we break all that down in today's market outlook video. We look at a trade idea today on the other side of the market that we haven't taken a look at for a while, that bearish side in a popular stock that just issued an earnings announcement. The market didn't quite like it. So let's go ahead and get started. Today is Friday, February the 1st, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see that we really slowed down today, or Friday here, this weekend as we rolled into the end of the week after that really robust jobs number we'll talk about here a bit later in the session today. We have reached the upper end. So if you draw Fibonacci retracements from the high down to the low, so the retracement being this rally of the October of this 20% decline essentially that we've had, then we are up to the 62% Fibonacci retracement level right now. So we're into the top end of the retracement zone. There also happens to be you'll see here in a second the 200-day moving average. There's other levels of resistance in this area that we're at. You can see that the red lines here are the Fibonacci retracements of any pullback that we may get from here if we get one. Right? You can see the 38% retracement of this rally would be to the bottom end of the retracement zone that we're climbing through right now. So that's about 25.75. So multiple layers of support in that area if we were to fall back down. Of course, the near-term line is bullish. It's back up, spending what, 3 days above 50, back into the 80. Strong bullish posture with the green line up above. We haven't got that nice little exhale yet after the strong rally we've had. We've had a few little brief dips of the near-term line, but nothing that's brought the intermediate line down below 50. And now for it to get down below 50, see, when it gets below 50 here, it doesn't take very much, like this kind of retest. Or even like here when you have this rally off of that low in February, this pullback, you can see it doesn't take very much to get below 50. The market sentiment line at that time was still falling. Over here, the market sentiment line was kind of flattening out. Right now, market sentiment's rallying. So it's going to be a little bit tougher and probably a little bit more of a bearish move for us to get down there. And by the time we did, you can see the intermediate lines, or the moving average here in green, is close to crossing up above it. So whether or not we get that remains to be seen. It would be healthy for us to get that. Last time we were this bullish without one was last January, and we saw what happened to that in February. How steep that drop off was, and whether or not we get that, you can see I've got cycles drawn here from these kind of bearish cycle low points, because since we're, according to the volatility chart, we're still kind of in this volatile bearish type of a market. There's still that possibility. We haven't entered from a volatility standpoint the nice steady bullish trend yet. We're still pretty volatile. Volatility is relatively still high, and trading ranges and volumes, our average volumes, are relatively still high compared to where they're at when we're entrenched in a bullish trend. So that being said, the cycle would suggest, if I were to, here, let's get rid of these indicators and take a look. And I brought up how to draw these cycles in our technical analysis class on Friday. So premium Market Scholar members, subscribers to our site, you can watch the recording for that class on our calendar. You can see how we drawn these cycles and what we did and how we got to this point and how they're used. You can see if I were to draw some, get some space off to the right, then right here by about that post February expiration date, you can see that's also the time that the Fibonacci fan that we've broken up above will crosses the Fibonacci retracement line at the 38% level, which can act as a support. Since we're above it, would act as a support if we were to get that kind of a decline. So this kind of a move would be about a 5% drop to the 38% Fibonacci retracement by towards the end of February, if not into the beginning of March, because it's not going to be exactly on on that one day there. You know, that's kind of the idea of what to expect. And remember, from a seasonality standpoint, if we were to take a look at the seasonality chart here, and then look at the 20-year, let's do this to prices percentage, you can see that we are well up above year-to-date returns. This is a typically a bearish time of year to get to February expiration. Is that 20? Do I have the 20 up? Yeah, okay. This is a typically bearish time of year, so considering how far up above we are year-to-date averages, it's going to be really easy for us just to pull back down towards those averages. Just like if we're below it, like we were here last year at the end of the year, we move our way back up towards it, like this move has done. So you know, from a seasonality standpoint, from a cycle standpoint, from a market forecast standpoint, there is an expectation of a move back down now towards about 25.75 since we continue to move higher. Again, that doesn't mean we were looking for a pullback back here a couple weeks ago, and that didn't happen. We were looking for more of a pullback here around this level, 26.35, and that hasn't happened. Whether or not we get that here, you know, the more we go higher, the more we get a move like we saw. And what we don't want is this kind of a move, right, where it keeps going more than you ever expected because of the lack of a pullback, of a significant pullback. It exceeds that expectations. That's usually the reality that comes afterwards when you exceed the typical expectations, right? You take a big enough inhale without the normal exhale, and really that inhale from the intermediate standpoint started way back here. You take a big enough inhale without the normal exhale anywhere in here, and according to the cycle, it should have been right about in this area that we were expecting, right here. That's where the normal bounce should have been. We didn't get that. That would have had a low point here in February. It's typical too, and it would have been higher. You know, we'd have progressively moved to higher lows to get there, but that kind of threw a wrench in things. We went so far above linear regression trend line that we made our way back towards it. And now, interestingly enough, if you take a look at that same linear regression trend line, we were so far below it, right? And look how far we've made our way back up to the actual linear regression again, and that can act as a support or resistance when you're moving up or down. See, when we were up above it over here, we were heading down towards linear regression at that point, which was in this area, and then we broke through it to the downside, seeing shift as candles come off the right over here and more gets added over here. So we're kind of keep an idea to see another area of resistance for this stock that can kind of stall us out potentially in this area. Really quickly take a look at the Dow Jones Industrial Average as well, and the other indexes. And they all look very, very similar, right? We're heading into some important areas, 25,000 for the Dow. You look at the NASDAQ Composite also stalling out Friday with some close to a overbought cluster on the NASDAQ. And then the Russell 2000, which did get an overbought cluster on Thursday after an insane number of consecutive clusters here, very similar to 2009's low, that we really have stalled out, and there's that possibility of that pullback. While the long-term trend is still relatively weak, being in the lower part of the chart. Okay, before we look at some other charts, a reminder, click this red button right below the video. That will subscribe you to our channel, our Market Outlook channel here, and give you notification when these videos are posted. You can also do that on any device. You'll see our little logo. Click, mouse over that logo, and then click the red subscribe button that pops out. That will also subscribe you to that. Also, click this thumbs up icon. That lets me know, number one, that you like the video, and number two, you want us to do the video again on Monday. Really quick, easy way to give us feedback. Again, the more you click on the thumbs up or the thumbs down, and the more you comment, the more that YouTube finds this as an engaging video that they should promote to other people. Right? Again, if you don't like the video, if you don't want us to do it, the way that you can tell us is don't click on anything, right? Because again, that's the worst thing actually you can do, is to watch and not click on the video. And again, comment on anything that stood out to you. You can see you have to sign in to do that. But comment on anything that stood out to you in the video right here, right below the videos. Click in there. and type in, and that way people that come to it can see what you all are getting out of it, to see if whether they should check it out or not. Over here on our blog, you can do the same thing. Click this heart right on tonight's Market Outlook tweet, and then like the tweet there. Same thing, click on this image, takes you to your Facebook account, like the Facebook post. Those two things, again, let us know that you want us to keep doing these videos. Really, really easy way to give us feedback. You can do it right now while you're watching. A reminder that we have our classes coming up for next week. The 2 classes here on Monday, and then Brandon's class on Friday or Tuesday. Dividend investing. You can click on view more to see the rest of our calendar. Here this weekend, Brandon just barely released the trading plans for all of his classes. So we are in the process of releasing more content in conjunction with our classes. Again, you can go to our blog. You have to be subscribed to our site to get to see this post. To subscribe to our premium section of our site to be able to get to our classes, and you can get all those trading plans and download them there. Be able to use them while you're watching classes, because during the classes, that's when in all of our classes, we in real time apply those trading plans and into what we're doing, like I said, in real time. Of course, he's also updated the sector selector, which is a proprietary tool that he has created, that Brandon has created, to rank the sectors and the industries and stocks within them. You can see the image here, but if you click on the post, again, you have to subscribe to our site to do that. But if you click on the post, you can see all the accompanying information below, including stocks and industry rankings as well. All right, back to the chart. So you can see that we have we're flirting with that 200-day moving average here. The 40-week exponential moving average is what we use for the 200-day. So look at that 6-week move. I mean, that's quite the rally from what was a really, really steep decline. Now, perspective on that decline. If you were to zoom out to a 20-year and then go back to a weekly chart, sorry about that. Go to a weekly chart and then do a log scale on this. Then you can see, okay, it was a decline. It was similar to what we've seen before, especially in 2011 we saw this before, and a little bit bigger than what we saw in 15 and 16 last times that we've been this bearish, and similar to what we saw in early 2008. So that's why we kind of watched that to see if we get a similar reaction now that we got to in the spring of 2008. If we are indeed starting a bear market, that's what we're going to be watching for. If you look at the 3 green arrow chart, you can see we're not anywhere close to that, as we are easily up above a rising moving average. We have 3 green arrows. MACD and stochastics have turned back up. Now, if you look at them here, the MACD is up to new highs, but the stochastics is not. So we're setting up for a possible bearish divergence heading into this. And that would set us up. The divergence would set us up for a move down to about 26.25. And remember, 25.75 is where that area of support is from a Fibonacci standpoint. So if that ends up being the case, and we kind of flatten out there, that might be what brings the 8 and 17-day back down, which is usually the case when you break up through so hard. Usually you'll bring them back down, you'll converge again, and then rally. So whether or not we get this kind of move around 25.75 or not, remains to be seen, and how long that would take. But you can see it took about an expiration cycle plus for that to happen over here, and then we started the nice slow bullish trend that was nice and steady and healthy until we ran out of gas over here with these bearish divergences at the end. Alright, if we take a look at the intraday chart, we did get up to a new high yesterday briefly at the very beginning of the day after the jobs release and the market open, and then we just kind of settled in the rest of the day and finished below yesterday's high. In the top end of yesterday's range, above last week's high. The purple line is actually going to be next week's Hakunashi Open. So if we do pull back, we'll kind of watch that area. We might get a little bit of a dip below that open if we are more bearish next week. More of a dip would mean that we're probably back into a transition from this 6-week strong rally to more of a, what we saw in March of last year, March and April of last year. So that's kind of what we watch for on an intraday basis. We have, this is going to move up to what, about 251, so about 4 points. That will move this up a couple of points up to 261, so up to this low area and this point, and that's going to only be there for a day, because then it will move up day after day after day You know, right? So it's going to gradually start, the low point is going to start moving up higher until we get to around this area of 260. So, you know, that's going to start moving up pretty quickly. And if we don't start moving up to new highs pretty quickly with a lot of resistance up above us, then it's not going to be very hard for us at all to really shorten up the range pretty quick to about 11 points from what is now, what, 24 points, so almost a 10% move. It will really shorten that up and make it really easy to trade into the lower half. And if it takes a couple of weeks, you know, the week after, you're probably going to get this Heikin-Ashi Open moving up a little bit higher. So it'll be easier to get a lower shadow, some movement below that purple line. Again, the Heikin-Ashi candle I'm referring to, for those that haven't been watching these videos for as long, are these candles here. So when you get a smaller body and upper and lower shadow, that's more of a transition. So we only got one transition candle here. Usually when you're bearish, you tend to get more transition candles before you start a bullish trend. We've only gotten one, and we've already started this bullish trend. So I wouldn't be surprised if we don't get more of a transition. You can see here you have a few, you got 1 week, then we had, you know, some bearishness and some transition, and then we had the nice and steady. So are we going to get something like this now, you know, testing into this lows? You know, I wouldn't be surprised at all if that's the kind of pattern we get. Alright, now from a volume standpoint, a trading range and a volume standpoint, oops, I need to go to the 3 green arrow chart here. I'll go 3 green arrows. You can see the trading range was just under, you know, under half, so 2, under 1%, so nice, that's actually a nice range. The volume at 85 million, so let's put those numbers in context here. 2 points is at the low end of the range. It's starting to bring this down. We're not back below 1% yet, where we feel, you know, that we are now entrenched in this bullish trend. We don't have to be. Like you can see, we're over here. We were about halfway there, between about 1.5% by the time that bullish trend started. We're getting close to that level again. Volume. You can see the volumes are really falling, having really dropped dramatically, and 85 million, a little bit below that. So we're making our way down as these head lower. You know, we tend to be more bullish through the ups and the downs. We won't go up every single day as these move lower, but so when it gets below 1%, that's when we're kind of set, where we can expect, you know, multiple intermediate rallies and more of a longer term move to the upside. All right, finally, on a volatility standpoint, the other factor that really hasn't played into the beginnings of a bullish trend yet, and why we're still kind of in more of a bearish market, is we haven't broken below this 90% level, which would more than likely coincide with 15 on the VIX on an absolute basis. We're still in the higher teens. We can make our way up to 20 on any kind of pullback and still be relatively bearish without being too bearish, right, to cause a bearish trend. We saw that again going back to last spring, last March and April. You can see that we did briefly go below 90 before rallying back up and then spending that month and a half plus up above in bearish territory. So before we finally broke through and stayed below 90 in the beginning of May, when that bullish trend got entrenched in there. So we're not to this point yet. We may still have this yet to come, this kind of a bounce, which again didn't change the trend. It was just it built the base. And as I mentioned before, when you look at the volume supply we still have the biggest volume node of the past 52 weeks still above us, as well as a lot of volume here from here to 280. So I mean, we can work our way through up to 280, but again, if we do, that means more of an inhale without the exhale, and it means more likely, not 100% likely, but more likely we get the kind of pullback we saw last February coming out of it. So it'd be more healthy to diverge into this resistance, pull back through. A lot of this volume will help hold us up, pull back down to this 270, 257, 50 area here, which would be your that 2575 area in the SPX, hit this area of support and then bounce off and head up higher, and then maybe even come down here and then stay in this volume area for a while before we build a base, break through 2800. Once we break 2800, then it's more clear sailing to the upside. There'll be a little bit of resistance at that node, but you can see far smaller resistance than the resistance that we have immediately above us right now. Okay, so to summarize, we are strongly bullish. We continue to be very strongly bullish, especially in the short term. We are heading into a very strong area of resistance for multiple reasons. And we have a kind of an expected amount of retracement on any kind of pullback we may get, if we ever get it, because we've been expecting it for a couple weeks now. And if the pain trade is still for stocks to go to the upside, then that's what will happen, and we'll move up closer to 2,800 in the meantime. But once we do, ultimately, because the markets, you can't inhale forever, right? You'll run out of breath. The markets will run out of buyers. You can't go up forever without an exhale. I mean, it doesn't have to be a bear market. It just has to be an exhale. If and when that does occur, we have an idea of timing with the cycles and the Fibonacci fans, as well as in conjunction with the retracement levels of how far we can drop to and how long that might take us. And ultimately, we've seen in the past that it could be a little bit more of a period of time of volatility, and we'll see if that ends up being the case this go around. So with that being said, what do you think? Do you agree or disagree with that? Click that poll popping out in the top right corner of your screen, then click either agree or disagree. If you click disagree, comment down in the comment section below what you're seeing that would suggest something different than what we've come up with here as part of our market outlook routine. Remember to follow me on Twitter for more content like this throughout the day in between videos. Also, join our daily market outlook email list that we've created. You can click the link popping out up there. That will also take you there. Once you go to our site for the first time, you can also subscribe with a pop-up there as well. And then finally, join our community we created on Facebook, our market outlook community, excuse me, that we've created on Facebook. All right, now let's talk about what's driving price action today. You can see the biggest mover the past 2 weeks has been crude oil. It had a good start to the 2 weeks ago, up 3% in one day, and then we fell back, and at one point was down 2% during this period. But finishing now at 5.5%. Emerging markets also finishing up strong, outpacing developed. Large caps outpacing small caps, interestingly enough. You can also see long-term bonds rallying with a weak dollar. Remember the FOMC meeting this week. You can see the dollar dropping post-FOMC, and that's where much of its losses have come after starting this 2-week period with a strong gain, putting pressure on emerging markets initially, and then finishing up. Agricultural commodities have struggled the most. They're down 1.5%. Remember, they're more sensitive to, they have their own seasonality issues, of course, but they're also more sensitive to any trade talk between U.S. and China and what may be going on there. You can also see gold really rallying. It's had a good 2 weeks, taking advantage of the weakness in the dollar and really taking off since that FOMC meeting. In fact, emerging markets, I mean, everything really took off from a risk appetite standpoint post-FOMC. When you look at the calendar, the biggest news, of course, was the employment number that came out early in the morning, and you can see here that it really just blew. It's 300,000 jobs blew through the estimates at 158,000. The unemployment rate actually went up, interestingly enough, and that's actually a good sign because that means our participation rate is going up. There's more people looking for jobs now. And they've been unemployed. If you're unemployed and not looking for work, then you're not counted as being unemployed. It's the unemployed people that are looking for work that are counted. So that just means that there's not only more jobs being created, but there's more jobs, according to that number, there's more people looking. That's why the unemployment rate went higher. You can see also average hourly earnings continuing to stay strong at 3.2%. Look at the year-over-year growth rate in the jobs numbers. Moving up, almost up to 2%. You can see the growth, the unemployment rate starting to move up too. That's pretty typical. Unemployment rate doesn't go up after the market starts recessions. It starts going up in anticipation of that because, again, of the idea that how bullish the employment market is draws in people that have previously not been looking for work, and now they're feeling confident enough in the economy to start looking for work again. It's interesting how that works. Of course, the biggest news is how that impacts interest rate hike expectations, and it bumped it up a little bit to 2.6%. If you look at the historical numbers here, the odds of us staying at where we're at by the end of the year, 2019, really took off post-FOMC, and the odds of getting a rate hike dropped down to practically nothing. That's the red line, with the odds of a rate cut jumping up to almost 20%. Pulling back this last couple of days, but had jumped up post FOMC to 20% again. So again, the market is is pretty dovish. The market is pricing in the fact that the rate hike cycle is over with. In the last 2 rate hike cycles, that preceded these past couple of recessions, preceded the market peak by 6 months to over a year. So we could still continue to have a pretty bullish year in 2019, even though the Fed may be done raising rates here, and that's going to have its impact in sector rotation and intermarket relationships. We've already seen the dollar start to weaken a little bit here. If you were to look at just the long-term chart of the dollar, you can see it's starting to roll over and head towards its 200-day moving average. If you look at some of the dollar versus some of its major competitors, you can see how the euro appears to be forming some support where it's at right now. If the euro goes up, that's weak for the dollar. Same thing with the pound. The pound actually broke up through its 200-day moving average against the dollar for the first time. Retraced a little bit this week, but a couple weeks ago, and that's of course bearish for the dollar. You look at it against the Japanese yen, and you can see the dollar is down. We've had a death cross. It's below that 200-day moving average. And then finally another one against the Australian dollar. Starting to get some bullish divergences forming here on the long term, and has the opportunity to start moving its way higher back up towards its 200-day moving average and beyond. So all of that would be bearish for the dollar, and that would be bullish for commodity prices. In particular, would be bullish for something like crude oil, as it's making its way through the Fibonacci into a Fibonacci retracement zone, and then especially would be bullish for gold prices, which for the second consecutive week has that strong move. In fact, this week kind of breaking through 1300 and staying up above there. So it's trying to make its way towards this 1375 area, 1350 to 1375 area, where its next layer of resistance is. Of course, breaking above that would be really bullish. And if you look, go back 20 years, we'll go back 20 years and go to a weekly chart. Again, the Fed stopped raising interest rates in 2006. From that point, and a little bit of a pullback there, but the gold really rallied into the end. That's where the stock market peaked. So you can see the move we had in bullish on gold heading into the stock market peak, and then continued higher even during the beginnings of the bear market. Remember, the bear market didn't start until really May of 2008, when we failed at the 200-day moving average and we rolled over. So heading up to the stock market peak from the Fed rate hike cycle ending, up through the stock market peak into its first pullback, its first death cross pullback, and then retest, gold really rallied. So that's kind of the mode that we're in. We're somewhere in here right now on the precious metal. And of course, when you look at international stocks and how they performed, again, the Fed stopped raising rates right here in 2006, the summer of 2000, well, right in this area, summer of 2006, and you can see from the Fed's rate hike cycle peak through the stock market peak in October of 07, through the stock market peak to the first, to that failed retest of the 200-day moving average. That's how emerging markets perform. So they really benefited as well during that time. So we're somewhere in here too. From an emerging market standpoint, there's a really good opportunity for some gains and growth in that area, as well as in beaten up developed markets. Again, there's where the Fed stopped raising rates right here, and you can see the rally it had up through to the stock market peak, and then there's the failed test of the 200-day moving average that started the bear market. A little bit, it was less bullish on that than emerging markets were. So we can see what the trade is from now until we get the stock market peak and then that next death cross, whenever that is. All right, now let's take a look at the sector strength. You can see the best performing asset class or sector over the past couple of weeks now, with this kind of bullish move in stocks, has been the real estate sector in the industrials area. Real estate's taking advantage of the drop in yields. If you look at the yields, the 10-year yield in particular, over the past few weeks, you can see a down week this week. It's been down for the past so many weeks. Real estate's taking advantage of that, and it's really starting to move as a sector, move higher. In fact, since yields peaked, you can say, let's say the week of November the 5th. Let's go back to the sector strength here really quick. Sector comparison there. And we'll go back to that week of November the 5th. So the end of that week, that's this week. So we'll go through, let's say, to the beginning of the 12th, all the way up till now. Let's go 30 minutes. You can see the sector that's benefited the most, and of course there's been a big decline in here, but the sector that's benefited the most from this drop in yields has been the real estate sector. Utilities is pretty flat from that time as well. Initially, it was up initially during that drop, and it's been gaining too. So those are interest rate sensitive sectors that you would expect to continue to outperform while rates, if rates continue to fall. We saw the 10-year note, which is a little bit influenced by the Fed policy. The 30-year note's not, and you can see the 30 years had a death cross of its own. It's retested already and is already moving lower. So a little bit of a bearish move on yields there. If you look at the Hakinyashi, we've had some bearish candles. We've had some ups and downs, some transition. So we'll see if we end up getting another bearish candle, then we'll get a resumption of the trend. If we get a bullish candle like one of these, then there's your transition to a new bullish trend. So the expectation is, because of the death cross, we've had the test, and we're still below it, the expectation is we'll probably get another one of these bearish candles and resume the downward trend back down towards 2.6. And again, the sectors that typically lead in that environment would be that real estate, utility sector, the interest rate sensitive area, and to a lesser extent, consumer staples as well. If you take a look at just what's happened here this week, so we'll just kind of change this time frame to just this week here. Whoops. All right, that would actually be right here. And let's go back to 10 minutes. Then you can see, you know, this was a very earnings-driven week from an equity standpoint. Energy stocks benefiting from the move higher in crude oil. You can see staples is up there. Real estate, of course, we just talked about. Utilities also. That's not your typical, like, look, the market's up 1.5%. It was started off weak with weakness in communication services, which really rallied up strong thanks to Facebook, up to 3%. Technology also finished the week strong after starting weak, 2.5% to up 1%. Discretionary was also weak initially, but has finished relatively flat. Financials, they struggle from rising rates. But interesting to see utilities, real estate, and staples all higher at the end of a really bullish, a relatively bullish week. Kind of just shows again just how maybe not so bullish we are, and as we head into a resistance area, those aren't the sectors you would want us to lead through that resistance area, because those are more safe haven. Those are areas that people put their money in when they're worried about more of a decline. All right, well, let's take a look at a stock here that had earnings here recently in this past week. Is McDonald's. Actually had a pretty decent, well, you know, it didn't have a bad earnings announcement, but the market didn't like it, and that's what matters the most. As you can see, since the kind of wild knee-jerk reaction post earnings release, it's been down ever since, and it has crossed below a falling moving average, with the intermediate line really close to crossing below 50 at the same time. So there's opportunity here for more of a little bearish trend to develop. There's other patterns too. You look at the 3 green arrows with the volume. You can see 3 red arrows, of course, with a spike in volume the last few days to the downside. You look at the Bollinger Bands from MACD, you can see we've pushed through to the lower half. There's not very much support down here below where we're at. So there's a easy fall for it to come down into this 170 area where there's a couple low points and a few old high points. And that's where the volume starts to pick up again, probably a little bit below 170. Take a look at the DMI chart for this, as we like to do here, and pull up the other DMI indicators that are associated with it. And you can see, you know, the negative line has fallen below. The negative line, excuse me, hasn't closed up above 25 yet. The positive line has fallen below 25, so not much of a trend either. We haven't turned negative, and this hasn't turned over, so we don't want to be too aggressively bearish yet, because we don't have that kind of additional confirmation from these two and the DMI indicators. And you can see the while we have crossed below the 30-day, the 8 and the 17 haven't yet. The 8's crossed below the 17, so we have turned bearish, and we typically do head lower once we do cross that threshold. There's opportunity here to the downside, just not to be too aggressive, and that's where we say, okay, well, Let's look at the March options and sell a call option. We'll sell that 36 delta, buy the 185. You can see it's a relatively wide spread, so we need to try to get in somewhere close to the mid as possible. We might, depending upon where the market's at on Monday, we might have to get filled in more around. As long as we get at least 116, that gives us enough credit to get into the trade to make the risk worth it. And that you can see it's a relatively high probability trade as it is at 67%. And you can see that break even if I were to put it here, and let's take a look at it on this chart here on the MACD. You can see my break even would be up above this most recent high that we had at the end of Thursday. So we'd have to clear back above Thursday's high point essentially to get to the upside, and then some, right? Because we'd be willing to lose 126 bucks. So right about to that 182.5 level, which would be right to the 4-week high point. We'd have to cross through that to get out of this trade. If you take a look really quickly at the long-term charts, you can see how we've got this like lower high and the long upper shadows the last 2 weeks. Those are really bearish signs with falling MACD on the long-term chart. If we look at it from a Hakenyashi standpoint, we've had the bullish candles the last few weeks. We got the small body in the upper and the lower shadow this week. That's potentially a transition week. So we'll take a look at it for not aggressively bearish trade because we're still in this long-term bullish trend, but at least one that can take advantage of any weakness in the short term. So that does this for today. Now I want to hear from you. What do you think about what we talked about today? Any questions, comments on the market outlook, on what's driving the price action, the news that's driving the price action, as well as our trade idea? Make sure you post in our forums on marketscholars.com. Remember, you have to subscribe to our site to do that. You can also comment down below on the YouTube channel if you're watching us there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment. Also, remember to follow us on Twitter for more content like this in between videos, and join our community that we've created at marketscholars.com, as well as on Facebook, our Market Outlook community there. Thanks again, everybody. Have a great rest of your weekend. Hope your favorite team wins tomorrow in the Super Bowl, and we'll see you all on Monday.